Stuart Darrell here with Darrell Capital Management. The current economic environment is drawing comparisons to the 1970s, an economic era many people aren't in a hurry to revisit. In the early 70s, oil prices surged following OPEC's oil embargo, and U.S. budget deficits expanded as government spending increased. Today, oil prices are elevated due to supply concerns, and deficits are once again deepening. While the 1970s and today share rising oil prices and budget deficits, the most direct link between the two periods is inflation. Although the numbers differ, a similar pattern has emerged, as shown in Figure 1. In the early 70s, rising fuel prices contributed to the spike in inflation. More recently, supply chain disruptions related to the pandemic drove the inflation rate significantly higher. In both instances, the Fed responded by aggressively raising interest rates and successfully subdued inflation, at least initially. After reining in inflation in the early 70s, the Fed was quick to cut short-term interest rates in an effort to counteract the 1973-75 recession, only to inadvertently reignite inflation. By the end of the decade, inflation had climbed to 13.3%. The rapid rise prompted the Fed to raise the Fed funds rate to a staggering 20% in an effort to temper runaway prices. The result was back-to-back recessions in the early 1980s. A resurgence in inflation, similar to what occurred in the 70s, is a primary risk today. The fear of a 70s-style rerun and its aftermath explains why the Fed is hesitant to end the current rate tightening cycle. The Fed is determined to avoid repeating its last errors. The implication is the Fed may decide to keep interest rates higher for longer. In terms of investment strategy, we are factoring in these developments as we look forward. If you'd like additional guidance or insight, read the blog below or schedule a call. Until next time.